Welcome to my channel. In today's video, we'll discuss a topic that many of you might be interested in: passive income through dividends and ETFs. Passive income is the holy grail of the financial world, making money without actively working for it. But how can you achieve that? Today, I'll walk you through some of the best strategies to generate passive income in 2024 by investing in dividend-paying stocks and ETFs. Dividends and ETFs are two of the most popular investment vehicles for building long-term wealth and generating income. But how exactly do they work? What are the pros and cons, and how can you use these tools to reach your financial goals? We'll also touch on the tax implications in the US for individuals investing this way. Stay tuned to find out how to position your portfolio for 2024 and beyond. Chapter 1. What is passive income? Before diving in, let's first define what passive income is. Passive income is money you earn without actively working for it. It's the opposite of active income, where you're paid directly for your work, like a job or freelance project. With passive income, the money flows even when you're asleep, traveling, or working on other projects. A classic example of passive income is rental income from a property. Another excellent example is dividends and returns from ETFs. With these, you receive regular payments through dividends or market gains without needing to manage the investments daily. The goal for many investors is to build a portfolio that provides consistent income over time, allowing the compound interest effect to work for you. Chapter 2. How do dividend stocks work? Dividend stocks are shares of companies that regularly distribute a portion of their profits to shareholders in the form of dividends. These dividends can provide a stable, predictable income source, making them especially appealing to long-term investors. How does it work? When a company earns profits at the end of a fiscal year, it can choose to distribute a portion of those profits to shareholders. Companies that consistently pay dividends are often in established industries and have stable earnings. Procter & Gamble and Johnson & Johnson. These companies not only offer regular payouts, but often also provide dividend increases, meaning they raise their dividend payouts each year, which can be highly attractive for long-term investors. Advantages of dividend stocks. 1. Regular income. Dividend stocks offer a reliable source of income, especially for investors looking for stable returns. 2. Long-term growth potential. Many dividend-paying stocks offer both dividends and potential capital appreciation. 3. Dividend reinvestment. By reinvesting your dividends, you can take advantage of the compound interest effect, growing your wealth exponentially over time. Disadvantages of dividend stocks. 1. Market risk. Stocks are volatile, and even companies with a long history of paying dividends can cut or suspend payouts during tough economic times. 2. Tax treatment. In the US and other countries, dividends are taxed as income, reducing your net returns. We'll dive deeper into this later. Chapter 3. What are ETFs? Now let's move on to ETFs. An ETF, exchange-traded fund, is a fund that holds a collection of stocks, bonds, or other assets. The major benefit of ETFs is that they offer broad diversification without the need to pick individual stocks or bonds. ETFs are especially popular because they are cost-effective and easy to trade. They trade like stocks on an exchange and provide access to an entire market or sector, without requiring you to buy multiple individual stocks. A classic example is the S&P 500 ETF, which invests in the 500 largest publicly traded companies in the US. By buying an S&P 500 ETF, you automatically own shares of all these companies, providing you with significant diversification. Advantages of ETFs. 1. Diversification. ETFs invest in numerous companies or bonds, reducing risk. 2. Low costs. ETFs typically have lower management fees compared to actively managed funds. 3. Liquidity. ETFs can be traded throughout the day, offering flexibility. 4. Stability and passive income. Many dividend ETFs invest in companies with strong dividends, providing regular income. Disadvantages of ETFs. 1. Less control over stock. Selection. You don't have control over which stocks are in the ETF, as it follows an index. Second, market risk. If the overall market declines, the ETF will drop in value, even if some of the companies inside it are doing well. Chapter 4. Dividend ETFs. The perfect mix? What happens when we combine the benefits of dividend stocks with ETFs? That's where dividend ETFs come in. These funds exclusively invest in companies that regularly pay dividends and bundle them into a low-cost ETF. This means you receive regular dividend payments while benefiting from the diversification and low costs of an ETF. One popular dividend ETF is the Vanguard Dividend Appreciation ETF, VIG. This ETF invests in companies that have increased their dividends for several years, offering both income and the assurance that these companies are well managed and poised for long-term growth. Chapter 5. Pros and cons of dividends and ETFs. Pros of dividend ETFs and dividend stocks. 1. Reliable income. Dividends provide a steady income stream, which is particularly attractive to retirees or people looking for passive income. 2. Diversification. Dividend ETFs offer diversification, reducing risk. 3. Long-term stability. Companies that regularly pay dividends are often well-established and financially stable. Cons. 1. Volatility in recessions. Dividends are not guaranteed. During economic downturns, companies might cut or suspend dividend payments. 2. Dividend taxation. In many countries, dividends are taxed as ordinary income, which can lower your net returns. Chapter 6. Taxation of dividends and ETF income in the U.S. Now let's dive into an important topic. If you invest in dividend-paying stocks or ETFs, you must consider the tax implications, as they can significantly impact your net returns. In the U.S., dividends fall into two categories: qualified dividends and ordinary dividends. 1. Qualified dividends. These are taxed like long-term capital gains, typically at a lower rate. The tax rate on qualified dividends ranges from 0% to 20%, depending on your total income. 2. Ordinary dividends. These are taxed like regular income, which could mean a much higher tax rate, up to 37% depending on your income. ETFs follow similar rules. Income-generating ETFs often pay dividends that are classified as qualified or ordinary, depending on the type of ETF. Additionally, there's the capital gains tax. If you sell your ETF shares at a profit, you'll need to pay taxes on those gains. The rate depends on how long you've held the shares. Chapter 7. Best strategies for 2024. Finally, here are some of the best strategies to maximize your passive income from dividends and ETFs in 2024. 1. Think long-term. Invest in strong dividend-paying companies and ETFs that provide stable dividends and long-term growth. 2. Reinvest dividends. Use the power of compound interest by reinvesting your dividends. 3. Diversify. Spread your investments to minimize risk. 4. Minimize taxes. Focus on tax-efficient investments and strategically plan your sales to reduce capital gains taxes. Conclusion. That's our overview of passive income through dividends and ETFs and the best strategies for 2024. By making thoughtful investment decisions and planning strategically, you can build reliable income streams over time. As always, keep an eye on the risks and tax implications. If you found this video helpful, please give it a thumbs up and subscribe to the channel for more finance tips. See you in the next one.